Most people think the great money gets made by spotting the next celebrity stock before everyone else does. I have almost never found that to be true. The great money is usually made one layer underneath the obvious story, one layer closer to the cash register, the pipeline, the toll bridge, the supplier, the bottleneck, the thing that has to be paid no matter which dream happens to be fashionable this year. That is why I think most investors are looking in the wrong place in 2026. They are staring at the same giant names, the same headlines, the same charts, the same talking points, and then they wonder why their results keep looking suspiciously similar to everyone else, as they call it diversification. A lot of the time it is just crowded comfort dressed up in respectable language. There is a machine moving money right now, and unless you understand how that machine works, you can spend the next year believing you own the market, when in reality you own a very concentrated bet on a handful of enormous companies that already dominate the conversation. I want to slow that down because this is where the real opportunity begins. The stock market is not a democracy. It is not a place where every company gets heard equally. It is a weighing machine, and the heaviest names get the biggest seat at the table. In a market cap weighted index, the larger a company becomes, the more of your dollar gets forced into it every time you buy the index. That is not a theory. That is the plumbing. So when millions of people say they are taking the safe route by buying the index, what they often mean is that they are sending fresh capital into the same giant companies that have already been lifted by years of passive demand. That works beautifully until it does not. I am not telling you those businesses are bad. Some of them are extraordinary. I own extraordinary businesses. I admire extraordinary businesses. But a wonderful business can still become an overcrowded stock. And when an overcrowded stock stops going up, the investor who thought he owned safety discovers he really owned concentration. That is the first thing I would want you to understand about 2026. This is not 2021. This is not an environment where you can buy anything with a fashionable narrative and assume time will repair your mistakes. The air is thinner now. The market is more selective. The difference between owning the right thing and the popular thing has become much more important than the difference between buying on Tuesday or buying on Thursday. That is why I am not asking the usual question. I am not asking which giant stock is going to become even more giant. I am asking where the money has to go next, if the big forces in the world stay roughly what they are today. That is a much better question. When I was younger, I learned that you do not need to predict the whole world to make a good decision. You need to identify the part of reality that is most likely to matter, no matter how people feel. I do not know what the market will worship 3 months from now. I do know that societies still need electricity, fuels, grids, metals, equipment, pipes, service contracts, uranium supply, and processing capacity. If the future requires more energy and more industrial build-out, somebody gets paid before the glamour names collect the applause that somebody is often not the famous company. It is the supplier behind the famous company. It is the toll collector behind the traffic. It is the picks and shovels business behind the gold rush. That old lesson never really leaves you. If you want to understand what I believe may become one of the most mispriced opportunities of this decade, start with a simple observation. The world is becoming more electrified at the exact same time it is becoming more compute intensive, more militarized, more supply, chain conscious, and more politically suspicious of dependence on strategic rivals. That combination changes capital flows. It means more money has to go into the physical layer, not maybe has to. When data centers multiply, power demand is no longer an abstract macro talking point. It becomes steel, transformers, gas turbines, pipes, service contracts, uranium supply, grid upgrades, cooling systems, transmission lines, backup generation, and all the boring industrial words that television never makes. Look glamorous when countries talk about energy security. That does not stay inside speeches. It turns into LNG terminals, drilling equipment, offshore work, storage, maintenance, repair, and domestic sourcing. When governments talk about critical minerals, rare earths, magnets, and industrial independence, that conversation does not end in a press release. It eventually lands on a mine, a processing facility, a magnet line, a fuel cycle, a contract, a balance sheet, and a small group of public companies that suddenly matter much more than they did 5 years earlier. That is the second thing I would want you to understand. The richest opportunities in the 26th of may not come from betting on the loudest destination. They may come from owning the infrastructure that every destination must pay. Now, I want to say something that sounds obvious, But it is where many people lose discipline. A thesis is not a stock. You do not buy a slogan. You do not buy a macro headline. You do not buy excitement. You begin with the flow of money, then the sector, then the business, then the balance sheet, then the valuation, then the position size, then the patience to do nothing until the terms are reasonable. That is how serious capital behaves. The amateur starts with the ticker, the professional starts with the river. So let me give you the river as I see it. The first current I see is this. Passive money has made the largest stocks even larger. That has been wonderful for the owners of those businesses. It has also created a market where more investors than ever believe they are diversified when in fact they are deeply tied to the same trade. When that happens, the next dollars do not always produce the best risk. Adjusted upside in the same crowded names. Sometimes the better odds move to the second-order beneficiaries, the businesses that are needed if the same broad story keeps playing out. The second current is energy. Artificial intelligence does not run on hope. It runs on electricity. A data center is not a metaphor. It is a physical machine with physical loads and physical dependencies. That means the AI boom is not only a software story, it is an energy and industrial story. The third current is strategic scarcity. If a nation decides it no longer wants to rely on fragile or hostile supply chains for uranium, rare earths, magnets, or industrial feedstocks, then capital has to move into domestic or geopolitically friendlier sources. That does not happen in one dramatic evening. It happens in contracts, incentives, capacity expansions, and long procurement cycles. Quietly at first, then all at once in stock prices. That brings me to the three businesses I believe are worth studying. Now, I am choosing my words carefully. Worth studying now, not worshiping, not chasing, not buying blindly because somebody on a screen sounded confident. I am talking about the kind of names I would put on a serious watch list if I wanted exposure to the next industrial wave without pretending I can forecast the exact weather every week. The first is Baker Hughes. That may disappoint people who wanted something exotic. Good. I have found disappointment to be one of the healthiest filters in investing. Baker Hughes is interesting to me because it sits in the physical middle of the energy story. It is not merely a romantic bet on oil prices. It is a business tied to equipment, services, LNG turbines, field technology, and the practical machinery of getting energy projects built, maintained, and expanded. In a world that needs more reliable power, more gas infrastructure, more industrial build-out, and more engineering depth, the businesses selling the tools often enjoy more durable economics than the businesses selling the dream. This is classic picks and shovels thinking. During a frenzy, most people chase the visible winner. I would rather ask who gets paid whether the customer strikes gold or not. Baker Hughes has the kind of industrial positioning that can benefit from LNG expansion, energy equipment demand, and long-cycle projects that do not disappear because the market gets emotional for 2 weeks. There is another reason I like businesses like this in a period like the one we are in. They force you to think in terms of backlog, installed base, operating leverage, service intensity, and replacement cycles, instead of only narrative momentum. That is a healthier way to invest. It keeps your feet on the ground. The second business worth studying is MP Materials. If you want a perfect example of why most investors arrive late, look at rare earths. People talk about them only after they become a geopolitical emergency. But by the time politicians are giving speeches about supply chain independence, the serious money is already reading the names of the few companies that can actually mine, process, refine, and manufacture what modern industry needs. MP Materials matters because rare earths are not just another commodity slogan. They sit inside permanent magnets, motors, defense applications, advanced electronics, and the hardware of electrification. A country can make all the speeches it wants about industrial sovereignty. At some point, it still needs a real supply chain. What interests me here is not simply the phrase rare earths. It is the structure. America has very few scaled, credible public ways to participate in the domestic rare earth chain. Scarcity of quality vehicles matters. When capital finally decides a category is strategically important, it tends to crowd into the few names that look institutionally investable. That creates the possibility of a stronger move than the casual observer expects, especially when the story graduates from theory to procurement. There is another reason I find this compelling. This is not just about electric vehicles. That alone made the subject easy to caricature for a while. This is broader now. It is about magnets, grid equipment, defense resilience, manufacturing policy, and the physical guts of the electrified world. Once a theme widens from one consumer story into a national industrial priority, the economics can become more durable than the market originally assumed. The third name worth studying is Uranium Energy Corp. Now we are moving into a more speculative part of the map, and I want to say that plainly, this is not a C.S. Candies type of business. It does not have the same predictability. It does not belong in the same mental bucket as a dominant consumer franchise with enduring pricing power. It belongs in the bucket where position size matters very much, timing matters more, and you must be comfortable being wrong without being ruined. Why bother with it at all then? Because the world is relearning an old lesson. Reliable baseload power becomes much more valuable when electricity demand grows faster than policymakers expected, and when nations become less willing to outsource strategic energy dependencies. Nuclear does not solve every problem, but it has re-entered the serious conversation in a way that was not true for a long time. When that happens, the uranium chain matters again. Uranium Energy Corp is interesting, not because it removes the risks, but because it is tied to the renewed push for domestic uranium production and a more secure fuel cycle. If the United States and its allies want more nuclear resilience, the conversation cannot stop at the utility. It has to reach the supply source. That is the pattern I keep returning to. Do not just look at the obvious beneficiary. Look at the required beneficiary. That single shift in thinking can change an investor's life. Now I want to deal with the emotional trap hidden inside stories like this. The trap is thinking that because the thesis sounds strong, the stock can be bought at any price. That is how intelligent people do stupid things. A good business in the wrong spot can be a bad investment. A mediocre business in the right capital cycle can produce an excellent run. A strong theme does not rescue bad discipline. If you are going to operate in sectors where money rotates aggressively, then you need to respect two things almost as if they are sacred. The first is staging. Do not dump a large chunk of capital into a story you only began understanding last weekend. Build familiarity first, study the sector, understand the balance sheet, read the filings, watch how the stock behaves when the market is weak. Learn the difference between a stock rising because institutions are building positions and a stock rising because retail investors discovered a catchy headline. The second is sizing. In my own life, I have made large bets when the odds were unusually favorable and the downside was tolerable. But that is the part people copy badly. They copy conviction without copying preparation. They copy concentration without copying selectivity. In more cyclical, more operationally sensitive, more policy-sensitive names, your risk should be sized so that being wrong is irritating, not life-changing. That is the grown-up way to play offense. There is another reason I like this framework. It rescues you from becoming a prisoner of headlines. Most investors wake up, check the index, check the same 6 giant stocks, and then spend the rest of the day pretending they have taken the market. S-pulse. They have not. They have only checked the loudest part of the market. Serious money does something different. It ranks. It looks at where the world is. It looks at where capital is moving. It looks at which sectors are getting stronger. Then it looks for leaders inside those sectors. In other words, it does not start with the stock. It starts with the flow. That sounds simple because it is simple. Simple is not the same as easy. Easy is buying what everybody already owns and calling that prudence. Simple is asking where dollars are most likely to go if the big forces keep pushing in the same direction. That question keeps bringing me back to energy infrastructure and critical materials. Now let me show you the deeper layer because this is where the opportunity turns from interesting to important. Most people think the next decade will be defined by software intelligence. I think it will be defined just as much by physical constraint. That is what the market underestimates. The machine can only scale as fast as power, copper, steel, cooling, permitting, fuels, transformers, grid capacity, magnet production, and feedstock. Availability allow the bottleneck is often not the thing investors are celebrating. It is the dull industrial layer beneath the celebration. Money eventually discovers that. It always does. That is why I believe the 26th of May represent one of the last large periods in this decade when retail investors can still buy many of these second-order beneficiaries before they are fully absorbed into the mainstream narrative. Once a category becomes respectable, the easy money is usually gone. The press arrives late, the institutions do not. And that leads me to a point I care about very much. I do not want you to hear this as permission to become a trader chasing every twitch of rotation. That is not the lesson. The lesson is that ownership now requires more thought than it did when liquidity was everywhere and nearly every chart was rising. you can still be a calm investor. In fact, you must be a calm investor. But calm does not mean passive in the mental sense. It means disciplined, selective, and honest about where concentration already exists. If your entire portfolio is effectively a derivative of the same crowded technology trade, then you may not be diversified. You may just be wearing diversification as a costume. A much better approach is to know what role each bucket plays. There's nothing wrong with owning broad indexes. There's nothing wrong with owning great mega-cap businesses. There's also nothing wrong with owning a smaller basket of industrial, material, and energy names. If you can explain in one sentence why the money must go there and what would prove you wrong. That last part matters. What would prove you wrong if energy build outslows, if supply catches up faster than expected, if policy support evaporates, if execution breaks, if the cycle turns, if valuations become absurd? The thesis changes. A real investor updates. He does not marry the story because he fell in love with how smart it made him feel. That is another reason I prefer this framework to prediction games. It keeps me humble. I do not need to know the exact future. I need to know what conditions would justify owning a business and what conditions would tell me the market has changed. This is where many fortunes are protected, not in brilliance. In honesty, let me bring this together in the plainest way I can. If the world keeps demanding more compute, it will need more power. If it needs more power, it will need more infrastructure. If it needs more infrastructure, it will need more machinery, more fuels, more minerals, and more domestic strategic supply. If passive capital keeps crowding the same giant names, then a portion of intelligent money will keep searching one layer down for cleaner risk-reward. That is the chain. And when I run that chain through the lens I have used my entire life, I do not arrive at meme stocks or lottery tickets. I arrive at businesses like Baker Hughes, MP Materials, and Uranium Energy Corp as places worth real study. Not because they are guaranteed, not because they are secret, not because someone on social media said they will moon, because they sit where money may be forced to go. That is a very different kind of idea. One final thought. People love asking for the next 10-bagger because it lets them skip the harder question, which is what kind of investor they are becoming. The market pays you not only for being right, but for being organized. If you can learn to follow capital instead of chatter, to study sectors before tickers, to respect position sizing, to let the world tell you where the strain is building, you will already be miles ahead of the person who keeps buying whatever everybody else is buying and calling that discipline. There is still time in 2026 to do that, but I would not waste much of it. The index can keep climbing and still leave you intellectually lazy. The headlines can stay loud and still blind you to the quieter opportunity. The crowd can keep chasing the obvious and still miss the businesses that are standing closest to the cash spigot. If I were looking for one last large wealth opportunity in this decade, I would not begin with what the crowd is celebrating. I would begin with what the crowd is forcing itself to ignore. Then I would follow the money. Then I would follow the machinery. Then I would follow the scarcity. And then, only then, would I decide which stock deserves a place in my portfolio. That is how long-term money is made, not by being first to a slogan. By being early to the structure beneath it before you buy a single share of any idea in this story. I would give you one test. Write down in one plain sentence why this business gets stronger if the world stays roughly on its current path. Then write down in one plain sentence what would break the thesis. If you cannot do both without hiding behind jargon, you do not yet understand what you own. That little exercise sounds small. It is not small at all. It is the line between investing and borrowing conviction from strangers. And if you can cross that line patiently, rationally, without the need to impress anybody, you will already be operating in a far smaller and far more profitable crowd than the one that keeps chasing yesterday. S winners, that more than any ticker, is the habit that builds wealth you get to keep.